A notes receivable is a formal written to pay an amount that is owed. You will have a specific due date, and usually you have to pay interest as well as the principal on the note. There are a couple of different reasons why a company would issue a notes receivable, but typically these can be issued in a settlement of an accounts receivable. So if a customer is having a hard time paying their account receivable, you might set up a note receivable for them instead. This will give them a specific due date and also allow the company to charge interest related to the amount that is owed. There are a couple of terms that you need to know in regards to a notes receivable. First, the amount is usually shown as well as the due date. The due date can be expressed in months or in days after the issuance of the note. The payee is the person who's going to receive the note. So this is the person who's going to receive the cash, whereas the maker is the person who makes the note, who has to pay the note off. Typically, you'll have an annual interest rate that is charged in the amount for the amount of principal that is owed. This has to be adjusted based on how long the note is open. And we'll go through some examples of that as well. The two concepts that give people the hardest time in regards to notes receivable are the maturity date and calculating the interest. So let's go through both of those. The maturity date is typically expressed as in months or in days. The difficulty comes when it's issued in days. We have to determine what is the maturity date, or when is this note going to be due, which means you need to know how many days are in each month. And you also don't count the day that the note is signed. So for example, if Brett Company wrote a $1,000 60-day 8% promissory note, the note was dated May 1st, so we don't count May 1st when we're looking at when this note is due. What day would this actually be due? So we need to find out when is 60 days after May 1st. May has 31 days, so we would count 30 days in May, and then we need to get up to 60, so we would go to June 30th. That accounts for all 60 days, and therefore the note would be due on June 30th. When you're looking at interest, the way to calculate your interest is you take the face value of the note, you multiply it by the annual interest rate, and then you multiply that in the time of the terms in terms of 1 year. For example, in our example, this note was 60 days. So when we look at how much time we actually held the note, we would take 60 divided by 360 to determine how much interest is due on that note. For bank purposes, we use 360 instead of 365 to determine the portion of the annual interest rate. And it wouldn't be accounting unless we talked about the journal entries that went along with issuing these notes receivable. So in this example, if this Brett Company wrote a $1,000 60-day note to settle their accounts receivable, we would debit the notes receivable and credit the accounts receivable, showing that that accounts receivable is no longer due. Instead, we increased our notes receivable amount. And then at payment date, we would recognize that we received cash, and we not only received the amount of the note, we also received interest, and this would be called our interest revenue. Now, sometimes if a note isn't paid on that due date, we would that's called dishonoring a note, and we would just set up the accounts receivable again for that customer. So then we would write off the note by debiting the accounts receivable and crediting your notes receivable. So just reversing that May 1st entry if they do dishonor the note. Now, because there's interest involved, we have to think back to our adjusting journal entries. And at the end of the year, we need to adjust for our interest accrual. We need to make sure that we show that interest receivable related to what is owed to us until that end of the year. For example, if this company has a $10,000 note receivable, they set it up on June 1st and it's a 5-month note. If their financial statements are prepared as of September 30th, we need to make sure that we recognize that we have interest revenue from June 1st through September 30th. Because remember, revenue must be recognized if it's been earned. So we're going to recognize that we received the interest revenue from June 1st through September 30th and set up a receivable for that amount. Again, we take the principal times that annual interest rate and multiply that based on the time that we held the notes. So in this case, it would be 4 months, even though that note is for 5 months in total. We haven't earned that other month yet. So when the note actually comes due, we would recognize the full cash amount we're going to receive, plus we're going to recognize the fact that we had a receivable in regards to the interest. We already recorded the revenue that relates to that. We'll write off that notes receivable, showing that we collected that, and then we'll also show that interest revenue for that last month of the note. If you want to look at the liquidity of your receivables, there's 2 equations that you can use. The asset turnover ratio, which assesses the liquidity of the receivables, and it measures how many times on average that company is collecting these receivables during that time period. You can also look at the average collection period, which it's used to assess the effectiveness of your collection policies, maybe looking at how efficient your accounts receivable are being collected.